This is Jigle FX, and welcome to this second series on Forex beginners course. So today we're going to be talking about basic Forex terminologies. So there are some very basic terms you need to know in Forex. Like Forex has a language, just like every other profession has some terms. Its language, its register, its words. So that's how Forex is. So when you familiarize yourself with them, as time goes on, you get used to them. They might be sounding strange, but you get used to them. So number one is PEEP. PEEP is the smallest movement in price. Actually, I would say that price is actually the price of the forex market is measured in pips. So, for example, if you look at your clock, if you want to know how much time has gone, all you have to check is second, minutes, and time and an hour. And the smallest measurement of time is seconds. So when I tell you that 1 second it just was 1 second, that's a small time. But when I say it's 1 hour just passed, see, that's a big time. So how to measure the price of market movement is actually in pip. And for most pairs, the pips are actually for decimal place. As you can see on the screen, I see 0.001 for most pairs. All right, so 0.001. So it means I'm going to talk more on this when in another series when we go into the charts. Don't worry, you get to understand them better. So if the price moves from 0.001 to 0.002 like that, then there's a pip move. 1 pip movement is for certain markets is different. We will talk more about that later. Number 2 is lot. Lot is the trade size. Now, if you want to trade, you are not giving somebody money directly. All right, we actually trade in lots. So, for example, you can enter into a trade with 0.1 lot, with 1 lot size, with 2 lots, 0.01, and all of that. So lot size is just like the trade size. So the bigger your lot size, that it means you are risking more in your trading. Don't worry, like I said, this might be sounding strange, but when we journey into the series more, you will get to understand what all of these things mean. The next is leverage. Now, leverage is just like the money that you borrow to increase your trade size. Actually, when you are putting money in your broker, of which I'll still tell you the meaning of broker. Broker is just like the middleman between us and the market. So we put our money, or give our money to the broker, and then they give us a platform where we can log in and trade. So if you actually, the money we are bringing in is very small. The forex market requires billions to be able to trade. So you now bringing in even $1,000, $10,000 is small. We'll talk about $50 and $10. So what these brokers do is that there is a way they multiply it in their system actually. So it's in a ratio, like you can see a leverage of 1 to 100. It means that any money you bring, let's say if you fund $50 in your account and your leverage is 1 to 100, it means that is 50 times 100. For every $1 there is for every $1 there is 100 times 100. So 50 times 100, that is 5,000. So if you fund an account $50 and the leverage is 1 to 100, it means that as you are trading, it will be as though you'll be trading with the capacity of somebody that have 5,000. So if you fund 100,000, if you are trading with 100,000, and your leverage is 1 to 100, it means you'll be operating, or you'll be able to trade with the power of 10,000. That's times 100. What if the leverage is 1 to 1,000? If your leverage is 1 to 1,000 and then you are trading with $100, that is 100 times 1,000. That's 100,000 you know. But then you know that when you are withdrawing, the leverage is not part of it, it's your own money. But to trade, leverage is added. So the next thing is spread. Spread is the difference between the bid and the ask price. Now, bid, the buy and the sell price, or the bid and the ask price. Now, when you say, usually, or on a normal, if you are buying a currency, it's more expensive than when you are selling it. All right. So, for example, you can buy dollars for example, in my country, you can buy dollars for 1,700, and when you have to sell dollars, you might sell it for example, actually, you might sell it for 1,600. So 1,700 buy, 1,600 sell. Usually that's how it is. If the cost at which you buy a currency is lower than the cost you sell, and so if that happens like that, the spread is going to be 100. You see that? So you bought something 17 and then you sold it 16. So that's the spread, the difference between the buy and the sell price. And this spread is very important. All of these things, you will see their importance when we go deeper into this series. Spread is important because if you want to trade, you'll be looking for a lower spread. The lower the spread, the higher your possible profit. So that is it. If you have a very large spread, it will reduce your chances of profit. All right, so let's head on. Please remember, if you have a question, you can drop it in the comment section and I'm going to reply to it. So the next thing is stop loss. Now, when you are trading, you would not want to lose all your money in trading. So assuming you have $100 you are trading with, and you are not willing to lose all the $100 at once. That if you are trading and it goes against you by any means, that you want to minimize the losses that you experience. So what you do is that you set what is called a stop loss, so that if the market comes to that price, you automatically triggers you out. Now let me give you an illustration. Assuming you bought let's say a bag of rice for 50,000, right? And then you are expecting that when the bag of rice rises to 100,000, you are going to sell it. So you were holding the bag of rice that you bought 50,000, waiting for it to get to 100,000 before you sell it. All right. Now, what if after buying it for that 50,000, actually I'm talking, the unit of this currency I mentioned is naira, right? I'm in Nigeria. So imagine that. So after buying the 50,000, imagine that the currency, the bag of rice dropped to 40,000, and you are still hoping that since it dropped to 40,000, you can still you are still waiting, you are hoping that it's going to rise. It drops to let me see 35, and you are still hoping. Now what stop loss is about is you'll be able to set a limit that if losses come to the, because as the price of rice is dropping, that's how you are losing. So stop loss is about you setting, we are not trading bag of rice, we are actually trading currencies, but I'm using this as an illustration. So if the bag of rice now drops, maybe you set a target, a stop loss target, that if the bag of rice comes to 30, then you will sell off, you will no longer hold. That is stop loss. If not, you don't know you don't know if the bag of rice will come to 10,000, and then the loss will be very bad. So usually when you are trading, as price is moving in opposite direction to what you expected, you set a limit that if it gets here, if it gets to this loss level, I'm not trading again, I'm out of it. So there's an automatic way of setting it. We'll learn that as we continue. Same with take profit. Take profit is the other way around, that you are setting a target. Maybe assuming that bag of rice rises to 50 to 100,000, and then you now saw that the price just keeps increasing every day. So it went to 100,000, and then you're like, let me leave it a little bit. Let me leave my rice a little bit. Let it get to like 150,000, and then it gets to 120, and you were happy. And then from 120, it jumps to 70, and it jumps to 40. So usually when you are trading, you would want to set a particular target that if I am in profit and price gets this level, I am automatically leaving the market. You want to set that, your exit. So that's what take profit is, so that you will not see money and then, since you did not buy or you did not close the trade, you incur losses. You just see money and then after everything you lose it. The next is broker. Broker is the platform to access the market. So I told you, how can we buy and sell? You are not with it's not a physical market. The Forex market is not a physical market, where you are buying and selling the currency. There's a platform we are using. And so how can you make connection with the market? It's through the middle people known as the brokers. So it's the platform by which you access the market. So you open account with a broker, then you fund the account, and then the broker will give you login details for you to be able to access the market and trade any currency pair you want to trade. And then next is slippage. We'll talk about how to choose the right broker up this series. Slippage, when you enter a trade and it executes at a slightly different price due to fast movement of the market, is called slippage. So this happens very well when there's news. You also understand this as we continue. So sometimes what happens is news. There's something we call news in Forex. When news is released, you get to know also. When news is released and you're trying to trade, the market is very, very volatile. And then sometimes, there's a slight difference between the price that you're trying to open at and where, it finally works through. And that's actually called slippage. And that's why many times we would like to avoid trading when there is news, a high impact news. Could be very terrible like that sometimes. Okay, next there's spread. I think we have spoken about spread. Spread is the difference between the bid and ask price. That is the buy and sell price. Liquidity, it speaks about how easily a currency pair can be bought or sold without affecting price. So high liquidity is equal to smooth price movement. So that's what liquidity is about. Just like the name sounds, how easily a market flows, and then it maintains balance. It just keeps, and that's why it keeps flowing and it maintains balance. As I said, this Forex market it's not ending very soon. Volatility speaks about how fast and how much price moves. So when the price is moving very, very fast, that is high volatility. If the price is moving slow, that's low volatility. And when the price moves very fast, you can easily make higher profit within a short time. But then you need to be careful, because if it goes in an opposite direction, you could also make losses within a short time. All right, so let's continue. Next is margin. Now, margin is the amount of money you need to open a trade. So, it's like a deposit the broker holds while you trade. Now, I'm going to go to a platform that we use, that the brokers help us log in. It's called MT5. By the time I get there, I'm going to you understand this more. Marginal call or margin call, margin call is a warning from your broker that your account is too low to support your open position. So if you begin to lose very well, you will see that your account will start showing red. Means that you're having a margin call, and at any point in time within that period, your trade can possibly be closed, and then you might lose. You might not be able to trade with that account again. Equity. Now, equity is real-time account value. When you are trading, assuming your balance is, so back to our bag of rice example, assuming your the bag of rice you bought for 50,000, the price gets to 70 and price is still moving, you have not sold it, you are still waiting and price is moving. So at that point in time, your equity is 70,000. Are you seeing it? Your bag of rice is still at home and price are freezing to 70, but you have not sold it. So at that point in time, your equity is 70,000. Then when you sell it, that equity now is just like the floating profit. So it's floating because it's not yet your own until you sell the bag of rice. That's when the profit becomes your own. So usually when you are trading, if you open a position and you are making profit or losses, that is actually your equity balance plus the profit or the loss you are making. That is your equity. So when you close the trade, it now becomes your main balance, your account balance. So, okay, I've spoken about margin, the amount of money used to open a trade. So usually when you want to trade, the amount you are risking for a particular trade, that is actually the margin. All right, so let's continue. Then you have free margin. Free margin is the money available to open new trades. So after you open a trade, whether you profit or you lose, the money available to open another trade is actually what free margin is. And free margin is equal to equity minus margin used, right? So I've explained what equity is: the floating profit, balance plus floating profit or loss, then minus margin. So drawdown. I know some of you are getting bored, this sounding very funny to your ears, but trust me, this is very, very important. It's good to know them. Drawdown is the percentage your account drops below its highest point. So it shows how much you are risking or losing before recovery. So if your account drops, if your account was $100 and then you begin to trade and then the account drops to $70, it means that you are on 30% drawdown, right? You're on 30% drawdown. If it drops to $50, it means you're on 50% drawdown. If it drops to $20, it means you're on 80% drawdown. So the percentage at which your account dropped from its highest point is actually drawdown. Then risk to reward. Risk to reward is how much you are risking versus how much you aim to gain. So for example, in our bag of rice, we are risking 50 to gain 50. So the ratio there is 1:1. But that is not very good for trading. In trading, you would want your ratio to be 1:2, so that if you are risking 50,000, you are expecting to make at least 100,000 on top of it. That is 150 altogether. So that's what actually risk to reward is. All right. So let's continue. So, and then there's something called ranging market. Actually, the market moves in three directions. The first direction of market movement is uptrend. We'll talk about that more when we enter into a series that deals with strategy. Uptrend, downtrend, and ranging market. So ranging market is when the market is not moving up or down. It's just moving by this side. So imagine that your bag of rice, you're expecting the price to go to 100, but then the price goes to 60 and comes to 50, goes to 65 and comes to 45, goes to rises again to 55 and drops to 50. That's a ranging market. It means the market is not actually going up or coming down, is going sideways. Okay, so the next thing is long. So you hear the term long being used in the market, and when you say going long, when someone say I'm going long, it means the person is buying. And also bull. When you hear bullish means buying. It means it's going up. And then when you hear somebody say I'm going short, that's selling. Sorry, that was a mistake. They're not belling. Selling means it's going down, and that's bear. Say the market is bearish, it means it is dropping. When you say is, so if my my bag of rice situation, if the price goes from 50 to 60 to 70, I can say that the market is bullish. And then if it goes from 50 to 40 to 30, I can say the market is bearish. So that is a downtrend. Then stacking in forex refers to adding positions in the same direction as the market moves in your favor. So I have my bag of rice, right? And then when the price gets to when I see that the price gets to okay, bag of rice does not really give a very clear illustration to this, but when you're adding position, if you see profit and you keep adding position because you are in profit, that is stacking. I need to be careful because that could be very risky. There's a way to do that wisely, which we'll talk about as we continue. Okay, then swap. If you are trading and then you leave your trade overnight, through the night into the next day, you are going to be charged a particular amount by the broker. That is called swap fee. So that's what swap actually is. Flipping is turning a small trading account into a larger one within a short time, which actually is a high risk, and you need high leverage. When we talk about leverage, you need a very high leverage to do flipping. So turning $50 into $500 in 3 days. Some people can even you can turn $10 to $1,000. That's the only thing people hear before they start forex. That's why they blow accounts. So there's a way to do this wisely. We'll talk about that as we continue. This video is getting long. Now look at this. This is an interface of it's called MT5. This is where we trade from. This is where you log in and trade from. And this interface is here. I want to explain to you. You can see up there, you see balance. The balance is $72. Equity, you can see the equity is 102. Why is 102? 72 plus, if you see up there, you see 29.95. that is the profit. The blue, since it's showing blue, it's telling you that this particular account of this person is in profit, $29.95. And if you add it to 72.16, it will give you 102. So you see that is a floating profit. Since he has not closed the trade, you can see US30 buy 0.01. That is the lot size, and the profit for the first buy is 2.81. US30 is a market. It's not actually a forex market. It's called stock indices. We'll talk more about that later. So he's buying US30 0.1 lot and 0.01, and you can see the profit. You can see the floating profit. Then you see the margin. Remember that margin is what the amount he was required to open the trade. That's how much is down as the trade is running. That's how much he put in for the trade. So that's $12. And then you see the free margin. That is how much is remaining in his account after risking that margin of 12.1. And then margin percentage. Actually, margin percentage is a percentage with respect to the margin. If your margin percentage is like 1,000, that is very, very great. If your margin percentage is around 100, that's bad. It means that you're kind of in margin call, and you might not be able to trade with that account any moment from then. So it means you are losing badly. So now, lastly, trading session. Oh god, this video is getting long, but then trading session. Now, trading session is there are different times, different markets, within the day. All right, there are different sessions of trading. And you have to choose a particular session you are trading. We'll talk about that later also. So we have the Sydney session. The major center is in Australia. We have Tokyo session. Major center is Japan, London, UK, New York, US. And it opens by 10 p.m. GMT and closes 7 a.m. GMT. So you will choose which is comfortable for you based on your country. Now GMT is the standard time measurement based on the London timing structure. That's Greenwich Mean Time. So depending on which country you are, like in my country here, our GMT is +1. It means that if GMT is 10 p.m., then our own will be 11 p.m. So you can go to your Google and check the GMT of your country, whether what it is, +1, +2, and all of that. So that you'll be able to know when you are trading which session is best for you, depending on what you are trading. So if you are trading a pair that is related to Australia, that is AUDs, Australian dollars, is good for you. Trading the Sydney session is good for you, and if it's USD AUD, means you can New York session is also good for you. So you have to find a session that flows line in line with the market you are trading, and then also balances with your timing. That is the best time you would want to trade. And for me, I trade US30 and gold, and the best time gold is USD SAU USD, and the best time for that is actually New York session. So majorly I trade New York session. That's GMT +1 here. So majorly I trade in the afternoon actually. So guys, I think this is it for today. Our video was quite long today. I'm going to stop here. If you have a question, you can drop in the comment section and I am going to reply to it. Thank you guys.